Hi, my name is Darren Joseph from HEJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. Today, I want to talk about the OBBBA, the One Big Beautiful Bill Act that's brought the statutory rate on international income in line with international norms. Well, kind of. What do I mean by that? So following on from previous video that we've done, if you want, you can have a look at previous video that we did on the shift from the GILTI to the NCTI. So that is the shift from the global intangible low tax income regime to the net CFC tested income regime, so the NCTI. So I just want to highlight the fact that a big change is the shift in the statutory rate. So under the whole Pillar Two agreement as proposed and piloted and by the OECD, the world as a whole was focused on this 15% anchor for international corporate tax rates, while the US GILTI system, back when the GILTI was a thing, appeared to have a rate well below that 15%. Anyway, so it appeared to have a rate well below the 15%. In theory, as low as 10.5% to 13.125%. However, GILTI had provisions that produce higher effective tax rates in practice. So the OBBBA effectively traded away some of the characteristics of the GILTI regime to cut taxes for corporations and then raise the statutory rate up to 12.6 to 14% range. This was roughly a neutral trade, but it gives the US at least a headline tax rate more in line with global norms. So 14%, even though it's not really going to be 14, it is the headline rate, and it probably fits better with the global debate and this whole narrative about a 15% minimum tax. Anyway, so one thing, for example, was how the US credited its companies for foreign tax paid. Under the TCJA from back in 2017, the US credited just 80%. So just 80% of the foreign taxes paid can be used to offset US liabilities. So falling short of the 100%, which is the norm under Pillar Two. So the OBBBA raised the foreign credit to 90%, reflective of a rise in global corporate tax rates to comply with Pillar Two. So that's a benefit. Another US quirk removed by the OBBBA is a provision called indirect expense allocation, which effectively requires more of a certain deduction to be taken against foreign income and fewer to be taken against US income. The change exposes some income that most countries would deem international income to the full 21% US domestic corporate tax rate. With mounting pressure to reach a 15% nominal tax rate, it made sense to remove these unusual provisions and instead derive the revenue from this simple NCTI tax rate. So in terms of the whole geopolitics of it, and to address concerns about, there is a narrative, as we know, that the US is a tax haven. So to kind of address that international concern, this movement of the headline tax rate to 14% is a definite win. My name is Darren Joseph from HEJ.tax.